Is the US dollar crashing? We're going to be starting a series on this channel talking about the US dollar crashing, the US dollar strength, and coming inflation and what does that look like, and some of the reasons that we see inflation, some of the reasons that we don't see inflation when it looks like that we should be seeing inflation. So the question is the US dollar crashing? Currently, it's not crashing. So what do we mean by crash? We mean that the strength of the dollar collapses, the reliance on the US dollar collapses. A lot of people don't realize that the world pretty much relies on the US dollar. It's known as the world reserve currency. If we discuss for a moment world reserve currency, Wikipedia says that a reserve currency is a foreign currency that is held in significant quantities by central banks of other countries, by the way, not just our own, by central banks or other monetary authorities as part of their foreign exchange reserves. The reserve currency can be used in international transactions, international investments, and all aspects of the global economy. It is often considered a hard currency or a safe haven asset. Hard currency is indicating that it's considered as solid as something like gold, for example. Now, is the dollar or any currency, any government-backed currency, truly as solid as a hard currency like gold or even silver? The answer to that is of course not. When other people in other countries have faith in your currency, it means that they're willing to hold on to that currency, they're willing to use that currency, they're willing to conduct business within that currency. Now you may think, why would another country want to conduct business in the US dollar? The easiest example is to think about third world countries. If a third world country has a weak economy, if they're concerned about what countries can do is if I let's just say that I own my new private island, we'll call it, whatever, the Wealth Island Pacific or whatever, and, I want to raise a military or I want to build roads, but I can't raise enough taxes from my citizens to pay for it. What I can do is I can go to you, who may head up another country, and I can say, hey, will you let me borrow the money? I'll pay you back. Well, way back, when people would pay back in their own currency or in the other. So I have two options. I can pay you back in my own, Wealth Island Pacific currency. But the problem with Wealth Island Pacific currency is if I can't raise it through taxes, I can just print it and I can give you that currency. But if I print it and give it to you, I'm going to devalue the currency. So let's just say I borrow $1 million of West Island Pacific currency. 10 years later, I give that $1 million back. But what if that $1 million all of a sudden is only worth $500,000 of your dollars? What happens? Well, I just stiffed you out of half the debt. So to avoid that sort of situation, I could say, you know what? I'm going to pay you back in your currency. So I'll pay you back in whatever your country's currency is called. And that's possible. And that would require me to, buy as much as your currency on the foreign exchange market as I can, and in theory I would pay you back with your currency. But what if you also had a weak economy, an emerging market? What if I didn't trust the value of your currency, you didn't trust the value of my currency? What could we do? Well, then we could use the world reserve currency, a third-party intermediary. Like in the current case of the world today, it would be the US dollar. Oil is priced in US dollars, and it's like the standard pricing of the world is currently US dollars. But it has not always been this way. Now, when you discuss the US dollar collapsing, what we're primarily discussing is the value of the dollar dropping and world losing faith in the dollar, and that it no longer becomes the world reserve currency. And potentially, even the citizens of the US could lose faith in the currency. That would be a total currency collapse. And one of the things that could lead to a currency collapse would be if we lost the world reserve status. Now, ironically, when you talk about world reserve status, if you do a lot of reading on this, you'll hear a lot of articles that will say, yeah, that's a rare event. It doesn't happen that often, which I think is so ironic because the average length of time for a world reserve currency to maintain its dominance is about 100 years. That's it. That is it. So let's look here. 3 major signs of precedent that precedes the fall of world reserve currency. We'll go through this just to give you, this is written back in October of 2019. I want to just scroll down real quickly before we talk about the article. This is a graph that just roughly shows you the different world reserve currencies going back all the way to the 1400s. So you can see, how do you define rare? 1, 2, 3, 4, 5, 6 different times. And the US is now coming up on, I don't know, we were the world reserve currency. So we're coming up, let's just say 1925 roughly. We're coming up on 100 years. What did I say? Longest world reserve currency? That's not right. We're coming up on 100 years. So historically, this is roughly a 100-year cycle. We are coming up on that 100-year cycle. So in order for things, for what happens in the cycle, that's what's important to recognize. Let's talk about this article for a moment, because I think it points out several things. And I think if you want to be able to understand your financial, if you want to understand the moves you need to make to be able to protect your family, your family's assets, I think you have to be aware of this stuff. I want to say something very quickly. Anytime that you wait for the masses to agree with you, you're already too late. When mainstream media says, hey, there's a chance that we could have a dollar crisis, when that comes out to the point that everybody understands it and agrees with it, meaning your neighbor agrees with it, the guy who lives across the street agrees with it, your grandma's like, yeah, did you hear that? We're gonna, it looks like there's a chance we're gonna have a dollar crisis. It is too late. We are unavoidably gonna have a US dollar crisis by the time you see, the masses start to agree with this. So this is extremely important to understand. You have to be ahead of the trend to make the proper financial decisions for yourself and your family. Let's talk about this. 3 major signs that precede the fall of the world reserve currencies. The story of reserve currencies is long and stretches far back into ancient times. As modern history shows, however, the average lifespan of fiat reserve assets is just around 100 years. Fiat means not backed by gold. Only has value because there's a government that says that it has value, essentially. This means that even the US's dollars period of dominance is probably nearing its end very soon, statistically speaking. But it's not mere guesswork, as there are distinct patterns that emerge prior to the fall of any world reserve currency. In this exploitation, 3 of the most common will be highlighted. We're going to go through this, and I've got a couple of articles, and we'll talk about each one of these, but you're going to understand how imminent it is that there's going to be a crash in the US dollar. Now, let me just back up for a moment. Is the US dollar crashing today? I just want to highlight this for a moment. This is the US dollar index that shows a strength. Clearly, you don't see anything yet. But the fundamentals always exist before the market catches up. Here's a very interesting, I don't even know what this website is, but they show the RS, where's it at? This is the actual S&P 500, and they show here it is. This RSI indicator, Relative Strength Index, is showing, which makes no sense, it's showing that currently the stock market's overbought. Fundamentally, this indicator is saying, hey, the market's hot, it's overbought. That part makes sense, because look at this. All this occurs when the COVID crisis hit. That's when all this occurred. So how is it that all of a sudden we're back near the all-time highs, even though there's still massive unemployment, even though there's been a lot of printing of money, debts are piling up, the fundamentals are not good. How in the world is it that we're shooting back up to the top? Do you see, if you just look at the market numbers, then you can say, hey, this doesn't make sense, or hey, this is inaccurate. Well, you're right, it's not accurate. But you may think that what I'm talking about in this video is not accurate. Well, what I would challenge you and tell you is that this proves the entire video, really. This is just one component. And something very interesting to take a look at. I want you to notice how back in the market, how much stable it was. This is more of a period of more organic type growth. When you see the market moving this large amount, this fast, this often, that is a sign of a problem. How can markets so big that should be the center of so many people's lives that can track one of the largest, arguably most stable economies in the world, at least that's what you would want to think, how in the world can the S&P 500 be this erratic unless it's being manipulated, unless it's not totally accurate, unless it's being priced in cheap money that doesn't have value? I don't know. You decide. Let me know in the comments what your thoughts are. So let's go through this here. To understand the end of any currency's reserve status, it is important to be familiar with the beginnings, as the former is informed by the latter. A good example of this is in the case of the British pound, which prior to becoming a reserve currency was turned from silver to paper with the creation of the Bank of England. The bank was created in the wake of crushing military defeat at the hands of France, and England wished to finance the creation of a more powerful navy. The central bank was thus given sole ability to issue paper currency. War and empire building would similarly play a leading role in the British pound's consequent fall from grace. Two other common factors emerging prior to the death of the reserve currencies are increased spending and easy credit, and sanctions on free trade. Easy spending and easy credit is the single best indicator. I want to look at something right here for just a moment. The U.S. is in 25 trillion, count it, that's 12 places, that's trillion, 25 trillion, almost $26 trillion in debt. And I want you to think for a moment about if you were a country and you held the U.S. dollar as a safe haven asset, as a form of paper gold, if you will. You had full faith in the value of that dollar. And you saw a country add $2 trillion, or I think it was what, $2.2 trillion in debt from the stimulus package? $2 trillion. You understand what that is? That's 10%. This is our country's entire debt for the entire history of the country. Think about that for a moment. The entire history of the country, this is the debt we've got racked up. And in one bill, they added 10% to that debt. Over $2 trillion, 2.3 was it? I think trillion dollars. In just one bill, they added 10% to the debt. Now here's the challenge. Most people don't pay attention to this. They don't get it. I mean, $1 trillion, it just sounds like big numbers. And most people, most of our recollection about, or most of our thoughts about our future are based on our past. Hear me. There's a reason Hitler was voted in democratically to Germany. And there's also a reason where many wealthy Jews had the chance to leave Germany but did not. Now, I'm not trying to make some sort of, statement about, I'm not trying to draw parallels per se to Hitler and the US government. That's not what I'm saying. All I want to explain is why did wealthy Jews, when they had a chance, not leave Germany? Because in their past, up to that point, they had never been persecuted, and it just seemed so improbable that could ever possibly happen. Just like many Americans don't think that America could ever not be a superpower, or they don't think that the American military could ever one day not be the greatest fighting force on the planet. They just think that would be totally impossible. And if you start asking questions and you're like, yes, but what if we couldn't afford it? Like, people can't wrap their brain around that. How is that? What do you mean we couldn't afford it? We're the U.S. government. We can afford anything. No, well, we got $26 trillion in debt. The real question is, why do we have $26 trillion in debt? No other country in the history of the world has been able to go into that much debt. Our gross domestic product, revenue brought in, is 19 trillion. And we're at 26 trillion almost. That's crazy. How in the world, you're only bringing in 19 trillion, you got $26 trillion in debt. How is that possible? Most of the time, countries pay back their debts by taxing their citizens. That's the single easiest way, or taxing their businesses, or creating a good environment where citizens and businesses can prosper, and then they bring in more in tax revenues, and that pays down their debts. But we're not bringing in enough to pay down our debts. We're currently at 146% of total debt to GDP, gross domestic product. The income tax reserve revenue. Do you see this? U.S. federal tax revenue. They bring in $3 trillion. What is that? Total state revenue, another $2 trillion. So we got $5 trillion, $6 trillion total local revenue. But this doesn't necessarily all go to the government. But even if it did, do you see what I'm saying? It pales in comparison. So what in the world, then what do you do? Well, what they do is they have to pay back their debt. And right now, our tax revenues basically help cover the interest on our debt. So at some point, we get to a place where we cannot pay back our debt. So what happens? Well, they print money. That's the simple version. It's more complicated than that. Basically, the Federal Reserve basically prints the money, and the U.S. government sells debt. I mean, it's just a weird situation that doesn't make any sense to most people. But all you have to understand is that it gets to a point that it is simply unsustainable. So the government only has two real options. We'll talk about that in a minute. We're going to talk about what those options are. We're going to kind of talk about what you can do as an individual, because it's important for you to understand not everybody suffers equally through difficult financial situations. So there are ways you can prepare yourself and prepare your family to protect your family. And it's also important to recognize, I want to point out something here for just a moment, because I often use that with the example with the Great Depression. Not everybody suffered equally during the Great Depression. However, something interesting about the Great Depression, I want you to think about something for a moment. If, like me, you're alive today during listening to this video, then it's important to recognize that if you watch the news media, it seems like the government had no choice but to issue stimulus checks to bail out economies. That's what the news will tell you. The irony is we went through the Great Depression, which so far currently was a far more difficult economic lull than what we have right now. And in the Great Depression, no citizens got stimulus checks and no companies were bailed out. Think about that for a moment. Think about that for a moment. All right, so what do? We'll get to that. I just want to give you some more data. You can say, hey, this whole thing's biased. Yeah, you're right. Wars and empire building. The U.S. is definitely doing that. When the war began, the United States, I want to read this. This is interesting. I don't need to read all this. Okay. Where's it at? The newly created Federal Reserve Bank in the U.S. would show up, appearing as a fiat hero thanks to the issuance of dollar-denominated credit to foreign countries, meaning that countries, the National Bureau of Economic Research summarizes one report noting this. Here you go. When the war began, the United States was a net debtor in international capital markets, but following the war, the United States began investing large amounts internationally, particularly in Latin America, thus taking on the role traditionally played by Britain and other European capital exporters. So here's what happened. One of the ways that they became the world reserve currency, or the US dollar became the world reserve currency, is they started lending money to people, and those people had to pay that money back. Prior to going off the gold standard, the US was one of the world's largest lenders. The largest lenders to the world. In fact, not one of, probably the largest lender to the world. After we went off the gold standard, that's when they really started being able to print money and manipulate the currency. At that point, we became a net borrower in the world. So notice that before the US dollar was the world reserve currency, we were a borrower. The way we became the world reserve currency is we became a lender. Now all of a sudden we are the world's largest borrower. Remember this? Where's it at? Remember this number here, 26 trillion. 26 trillion. And most Americans know that's never going to get paid back, so what happens? That's why there's a coming US dollar crash coming. Now you may say, hey, look, this is Bitcoin.com, et cetera, et cetera. You're right. This could be biased. This is older. This is back from October. Let's look at something more recent, like yesterday. A crash in the dollar is coming. This is written by Bloomberg. The era of the U.S. dollar's exorbitant privilege as the world's primary reserve currency is coming to an end. Then French Finance Minister Valéry Giscard, however you say that, coined that phrase in the 1960s, largely out of frustration, bemoaning a U.S. that drew freely on the rest of the world to support its overextended standard of living. For almost 60 years, the world complained but did nothing about it. Those days are over. Now, if you're an American, that sounds crazy, because most Americans, there's this American exceptionalism that we don't realize that we only enjoy the standard of living that we have today because we think we're all self-sufficient. It's not true. We only enjoy our current standard of living today because of other countries, because they lend us money. Our government cannot afford what they're paying for and what it's providing for its citizens today without borrowing from other countries. Those countries, what they do is they buy our treasury bills. That's one of there's a lot of ways, but basically government-backed securities. They buy those treasury bills, and that's one way that they hold dollars. And the U.S. government pays those back at a very low interest rate. So they're borrowing money. And if those countries would not allow us to borrow money for whatever reason, then our government could not afford. Remember, we're one of the largest debtor nations in the history of the world. I mean, that is as crazy as that actually sounds when I say it out of my mouth. It's the truth. Already stressed by the impact of COVID-19 pandemic, U.S. living standards are about to be squeezed as never before. At the same time, the world is having serious doubts about the once widely accepted presumption of American exceptionalism. Currencies set the equilibrium between these two forces, domestic economic fundamentals and foreign perception of a nation's strength or weakness. The balance is shifting, and a crash in the dollar could well be in the offing. The seeds of this problem were sown by a profound shortfall in domestic U.S. savings that was glaringly apparent before the pandemic. In the first quarter of 2020, net national savings, which includes depreciated adjusted savings of households, businesses, and the government sector, fell to 1.4% of national income, which was the lowest reading since late 2011 and 1/5 the average, 7% from 1960 to 2005. Basically, they're saying the savings rate, the net national savings rate, went from 7%. Americans aren't saving money, basically. Lacking in domestic savings and wanting to invest and grow, the U.S. has taken great advantage of the dollar's role as the world's primary reserve currency and drawn heavily upon surplus savings from abroad to square the circle. But not without a price. In order to attract foreign capital, the U.S. has run a deficit in its current account, which is the broadest measure of trade because it includes investment every year since 1982. COVID-19 and the economic crisis it has triggered is stretching this tension between savings and the current account to the breaking point. The culprit: exploding government budget deficits. According to the Bipartisan Congressional Budget Office, the federal budget deficit is likely to soar to a peacetime record of 17.9% of gross domestic product in 2020, before hopefully receding to 9.8% in 2021. A significant portion of the fiscal support has initially been saved by fear-driven, unemployed U.S. workers. That tends to, whatever that word is, some of the immediate pressures on overall national savings. However, monthly Treasury Department data show that the crisis-related expansion of the federal deficit has far outstripped the fear-driven surge in personal savings, and the April deficit 5.7 times the shortfall in the first quarter, or fully 50% larger than the April increment of personal savings. In other words, intense downward pressure is now building on already sharply depressed domestic savings compared with the situation during the global financial crisis, when domestic saving has a net negative for the first time on record, averaging negative 1.8% of national income from the third quarter of 2008 to the second quarter of 2010. A much sharper ratio into negative territory is now likely, possibly plunging into the unheard of 5 to 10% zone. That's actually crazy. And that is where the dollar comes into play. For the moment, the greenback is strong, benefit from typical safe haven demand, long evident during, by the way, greenback is the dollar. The greenback is strong, benefiting from typical safe haven demand, long evident during periods of crisis against a broad cross-section of U.S. trading partners. The dollar was up almost 7% over the January to April period in inflation-adjusted trade-weighted terms to a level that stands fully 33% above its July 2011 low. Bank for International Settlements data show, but the coming collapse in savings points to a sharp widening of the current account deficit, likely taking it well beyond the period record of 6.3% of GDP that is negative 6.3% of GDP that it reached in late 2005. Reserve currency or not, The dollar will not be spared under these circumstances. The key question is, what will spark the decline? Look no further than the Trump administration. Protectionist trade policies withdrawn from architectural pillars of globalization such as the Paris Agreement on Climate, Trans-Pacific Partnership, World Health Organization, and traditional Atlantic alliances, gross mismanagement of COVID-19 response, together with wrenching social turmoil not seen since the late 1960s, are all painfully visible manifestations of America's sharply diminished global leadership. Okay, I only agree with part of this because this is like kind of crazy. This didn't have everything to do just with Trump, but one of the single biggest complaints I have with Trump is he's not fiscally conservative at all, and that's pretty scary. I mean, he's spending money like crazy. He was spending money like crazy even before COVID. So the question is the U.S. dollar crashing? It's absolutely on its way to crashing. Now let's go to one more article. Here we go. This is Bloomberg. This is today. History shows dollar's worst rout since 2006, extending after Fed. Traders looking to short the dollar have history and monetary policy on their side as seasonal trends and a dovish Federal Reserve align further, sapping demand for currency, suffering its longest losing streak since 2006. The Bloomberg Dollar Spot Index declined in June in 8 of the last 10 years by an average of 0.7%. This month is already down about 2% of the Fed's meeting on Wednesday. All right, so, and here's what's interesting. I want to back up here for a moment. When it talks about savings and why savings is important, so savings is important but when citizens are able to save money, governments can draw from that. If you can get your citizens to start spending the money they've been saving, then you're going to be able to bring in revenue in the form of sales tax, for example. However, and the other issue is you're not put in a position where politically you feel like you have to do something. If every U.S. citizen had 3 months or 6 months or 1 year in an emergency fund savings account, which by the way was far more common 50, 60, 70 years ago when credit wasn't very easy to obtain. But in this day and age, most people literally, their emergency fund is a credit line or to be able to live off the credit card. Or they literally subsidize their entire life with credit, meaning home financing, car financing. I mean, there's almost nothing that Americans in this day and age don't finance. You can finance ATVs. You can finance a TV, for God's sakes. So when there's no savings because everyone has so much debt, now the government is in a political position where it's like, what do we do to support the citizens? And here's the challenge. We get the government that we deserve. And that can sound harsh. Most people don't understand this financial stuff. And that's part of the reason I'm making this video. Most people don't understand what's going on. Most people, if you are a little bit more in the know, if you have a business and you have employees, specifically if you deal with politicians, then you can kind of be a little bit in the know. In fact, I've got someone I'm going to show you here in a moment who was a little bit in the know because of his business, and it's interesting to listen to him. But what's fascinating is that a lot of people don't recognize what's going on, and so that they want the government to bail them out. They want government to help them out. Now, I think part of what should happen is that the government should do a little less helping, because in the long run, this is going to be bad for all of us. I mean, it's our policies that are going to lead to the collapse of the dollar, or the crash of the dollar, however you want to say it. But the challenge is the government only has two options. Either, I told you earlier that during the Great Depression, there was no major bailouts. There was no stimulus checks. And essentially, the economic financial cycle was allowed to kind of work itself out. And whether you agree or disagree whether, there should be zero government help, the reality is the only way the government can help is to borrow more money they don't have, which ultimately will create inflation. There's no way around it eventually. The government can't raise interest rates because if they raise interest rates, it's going to basically destroy the economy. And they probably should raise interest rates. We probably should go through a stagnant phase and try to rebuild with, far more solid assets that aren't over collateralized or over, subsidized through lending or borrowing money. However, that's not very politically expedient. So, for example, if you were running for president, you were like, you know what, ladies and gentlemen, here's what we're going to do. We're going to let freedom and liberty rule the day. Liberty doesn't really win votes. Liberty creates revolutions, and people fight for liberty in revolutions. It's how America was founded. But when people vote for a politician, they want someone to fix their problem. They're never going to vote for the guy that says, hey, there's nothing wrong. The system is working as it should. They're never going to vote for that guy. They're going to vote for the guy or the gal that's like, yep, here's how we're going to fix it. Even if it just means kicking the can down the road 5 years, 10 years, or 50 years. What can we do to prevent the pain today? And unfortunately, that's the route politically that the American government takes. So I want you to listen to something very quickly because I think this is interesting. Dana White, I got a little clip I want you to hear, recently started talking about, he's one of the first sporting events to come back, the UFC, if you're familiar. He's one, by the way, if you like the UFC, smash that like button. And if you like the content that I've discussed so far, if you agree with it, if you've learned anything at all, do me a favor, smash that like button and tell me down below what you agree with, or if you disagree, let me know what you disagree with. But we're going to listen to what Dana White has to say right here. I want you just to hear this for a moment. He basically talks about some of the pressures of his business. So let's just listen.
And believe me, I hate to be, Mr. Negative, but I don't even think, I don't think the worst is still yet to come. The worst is still yet to come. You're going to see a lot more people in this country getting laid off. If you just look at the financial situation, being off for 3.5 months, right? And you look at the stock market, and you're like, does that make sense? Right? There's going to be a huge domino effect. It's going to start with layoffs, bankruptcies, then it's going to hit the real estate, and God knows what else. And this COVID shit, who the hell knows what's going to go on with that thing? And so these are, you see these commercials. These are very uncertain times. Yeah, you think? Who knows, man? I haven't laid off any of my people. I'm trying to take care of all my people, including the fighters, keep them working, and, I'm doing everything in my power to do what I can do.
So he said it there, the fundamentals don't make sense, right? So people have been laid off for 3 weeks, but how in the world, people have been laid off for 3 months, but how in the world have we seen this sort of rebound in the stock market already? It's not because they've got the profits to prove that. So what's going on? Investors warn COVID-19 crisis is paving the way for inflation. Huge stimulus could lead to red-hot price rises over the long term, says fund managers. This is important. Listen to the smart money. Guys who are investing, guys who make a living investing. Powerful shots of stimulus from governments and central banks will push up inflation once the immediate COVID-19 crisis fades, according to some high-profile fund managers. At the moment, most money managers and economists reckon deflation is the more immediate risk. The eruption of mass unemployment, stay-at-home orders, and social distancing together constitute one of the biggest shocks to economic demand in history. Notice that word there, in history. That can't be overemphasized enough. People don't realize how rare of times that we're in right now. Yet some investors argue that the real longer-term threat is the return of inflation. As policymakers' dramatic interventions to prop up demand ultimately drive up prices, we're witnessing the greatest monetary inflation and unprecedented expansion of every form of money unlike anything the developed world has ever seen. Paul Tudor Jones, one of the greatest hedge fund managers in history. High debt accommodated by money printing is difficult to banish. Inflation expectations could one day respond to this reality. Think about that. He said high debt accommodated by money printing is difficult to banish. Now, why is that? Because it's debt on top of debt. It's like there's debt, but how am I going to pay back my debt? It's like if in your house you were like, oh, my debt's too high. I can't pay back my debt with my job. So let me just print some counterfeit money in my basement and get some money orders and pay some bills because my job won't allow me to do it. But then all of a sudden, it's like you go to the bank and you say, hey, you know what? I make $100,000 a year, but I can tell them that I make $150,000 a year because I can just print that extra $50,000. So they're basically giving you a loan on top of your fake money. So it's like an additional loan on top of fake money on top of fake money. And there's like this compound effect that takes place. That's literally essentially what the U.S. government is doing because it's not like they have an income earning cap like your $100,000. they can say they do have a cap. The cap is based off of what they can raise in taxes, but they're able to reissue money, reprint money, and as the world reserve currency, this is important. Let me get back to that. They're able to pay back their debts in their home currency. If the US dollar loses reserve status, that's where this is going to be a real problem, particularly for the United States. I mean, a real problem. You're talking about financial destruction on a very major scale, because there's nothing the government can do. They're going to be severely limited because they can't borrow money the way they borrowed it before to pay for everything that they've got. So everything they provide for their citizens, all the services, etc. Hedge fund manager Crispin O'Day also expects inflation to get pretty red hot. The founder of London-based O'Day Asset Management is reluctant to bet on such an outcome as long as economies are in lockdown and the markets remain focused on the threat of deflation. But he argued inflation is ultimately, listen to this, argued inflation is ultimately unavoidable given the level of stimulus. It's unavoidable. That's a problem. Now, here's the biggest issue with inflation. If you've been saving money, it destroys the value of your savings account. And now, if you've gotten this far into this video and you don't understand what inflation basically means, it basically means that if a loaf of bread costs $3, then the loaf of bread is still a loaf of bread, but next year it could cost $6. That would be 100% inflation if that happened. That's never happened that's never happened in the U.S. at this point, but that would be 100% inflation, meaning that you worked your entire life to save money in a savings account or a retirement account, and you didn't put it in the stock market because the stock market was risky, so you just left it in dollars, and you get $1 million saved up. Well, if there's 100% inflation, it means all of a sudden your $1 million will only buy about $500,000 worth of goods. Another way to think about it is this way. An ounce of gold has always had roughly the same amount of purchasing power. Always. A nice suit could have been bought in 1900 with an ounce of gold. Back then it's probably valued, I don't know, $20, $30, who knows. Today, an ounce of gold, I don't know what the price is today. I haven't looked recently. Probably over $1,000, probably $1,200. I'm not sure. Let me know in the comments when you watch this video, what is an ounce of gold worth? That would be an interesting number to see. You can still buy a nice suit for, roughly $1,200. An ounce of gold has always pretty much maintained its purchasing power. And you'll hear people say that gold, I got another video coming up where someone said that gold is a commodity whose value fluctuates heavily. No. The fiat price people are willing to pay for that purchasing power, but the purchasing power of gold has always been the same. So what can you do knowing this? First thing that you need to do, and this is not going to be comfortable, you're not going to want to hear this. Nobody ever wants to hear what's good for them. So I'm going to get this, and I've got more coming. I've got more information coming that's going to be helpful to you. So be sure to subscribe to this channel, because when I tell you this, you're not going to like it. But subscribe to this channel anyway, and I promise we'll be getting better information to help you out as you navigate this. The number one thing that you have to start doing sooner than later is start paying off your debt. Start paying off your debt. And you have to do everything in your power to start paying off your debt as quickly as you can. And there's something called a debt snowball. I'll create a video about that. I just thought about it. But that is the worst. I mean, I could tell you what I think you could invest in or should invest in if you're concerned about this. But before you make a single investment, I believe that you need to start paying off your debt. If you've got a credit card with a small balance, or if you've got a small personal loan with a small balance, get it paid off. And here's why. Because when the rubber meets the road, a lot of these financial institutions are going to become aggressive in trying to collect on their debts. And they're not going to care whether you have a job or don't have a job. They're not going to care whether you can't, because of inflation, if that were to occur, you can't afford to pay your light bill, or to put groceries on the grocery store prices get so high that you can't afford to, and we're talking worst case scenario type stuff, but we have a warning now. You have a warning now. Don't go get into more debt. And here's the challenge. It's going to be tempting, because banks want your business and they're going to offer very cheap loans. That's what all of this crisis occurs, because borrowing money becomes cheaper and cheaper and cheaper. And so people are like, wow, interest rates are lower now. Wow, I just had a buddy tell me that he was looking at getting a loan, a business loan, some sort of special loan because of this pandemic, that 30 years to pay it back, and it was really low interest. It's look man, it's only like a couple percent interest. And I'm like, what are you doing? This is the worst time in the world unless you have absolutely no other choice to survive or to keep your business afloat. And even then I wouldn't do it if I thought it was going to take me 30 years to pay it back. But this is the worst time in the world to borrow money. Don't just borrow money because you think it's cheap. That it's only going to be cheap. Here's what happens. Hear me on this. The damage or the pain almost feels non-existent until the house of cards finally comes crashing down. So what's going to happen is we'll see warning signs. We're getting warning signs now. I've showed you news story after news story, recent news story. We've got warning signs now. A big warning sign is the fact that we've had unemployment. People have been unemployed for 3 months in the largest corporations in the world, and we're seeing all this bounce back to almost near normal levels. It's insanity. We're seeing that, according to the RSI, it's overbought. RSI indicator says, hey, it's overbought. No kidding, it's overbought. But we got warning signs now. So the single best thing you can do is pay off your debt. With that being said, you want to think about investing at least a portion. And this is not financial advice. I'm not a financial planner. It's just what you want to consider looking at. And I'm not going to tell you what percentage to do what in. You think about that. But you want to start investing into assets that can, hard assets that can provide a return. It's pretty good to try to stay liquid as much as possible. Meaning, I like real estate as an investment if you're able to invest in real estate. But at the same time, if it takes everything you own to invest in real estate, you kind of want to stay liquid, because there will be opportunities to buy real estate probably far cheaper than we have now. That's a whole other video for another time. You want to look at alternatives to the fiat system. That could be precious metals, any asset that could produce an income. It could be small business that you can start. If you can create a secondary income source, I highly recommend that you start looking for a secondary income source. I've got an entire course about starting a business based on cryptocurrencies. If you want to check on that, it's the kind of thing you can do from home. It doesn't take a lot of overhead. You don't need any employees. You can do it with the internet. Just subscribe down to the Crypto Passive Profits newsletter down in the description. And once you do that, you'll be forwarded to an entire video. You want to watch that video that talks about creating a cryptocurrency business. But anything that you can do to be able to give yourself flexibility in the current environment, meaning that, someone told me one time, a good rat always has more than one hole to crawl into. You want to have multiple streams of income, if you will, that can be in various different segments or sectors, if possible, particularly passive income. If you have passive, that's one thing that I like about real estate. I like it from a rental standpoint because people will always pay rents, and rents go up with they typically follow inflation. So, but the single biggest thing that you can do today, above all else, is start working on paying off your debt. Do everything that you can to pay off your debt, because then you're going to have more income to be able to be nimble with, to be flexible with. Be sure to hit that subscribe button. I'm going to be putting out, we're not done with this series. We're going to continue with this series. We're going to be, I've got a couple more videos coming up. I've also got a video that I'm going to be doing towards the end of the series about, how you can basically become a millionaire, because there's going to be a lot of opportunities right now. What I believe, my opinions on what you can do to become a millionaire in today's buying power, and be able to take advantage of the opportunities that are going to exist. Keep in mind, not everybody suffers at the same rate, and there are always brand new millionaires created out of market crisis. If you want to be a brand new millionaire, type down in the comments if you're still with me. I want to be a brand new millionaire. And then hit that subscribe button, hit that bell notification icon, and give this video a thumbs up. Thank you so much for watching. Stay tuned for my next video.